All these finance videos telling people to buy this or that ETF can feel intimidating. I completely get that, and I have been sharing my view that buying equity index ETF is a good approach for most beginners. But I haven't really explained how all of this fits together. And if you stick with me till the end of this video, you will have a much clearer understanding of what ETFs are and how they connect to the stock market. Let's start with the basics. ETF stands for Exchange Traded Fund. An exchange is simply a marketplace where financial products are bought and sold. For example, in the UK, we have the London Stock Exchange, and in the US, there is the NYSE and NASDAQ. Every country has an exchange. Traded just means something that can be bought or sold, and a fund is a basket, a collection of assets. So when you put it all together, an ETF is a basket of assets that you can buy or sell on an exchange. That leads to the next question. What are these assets that go inside this basket? An asset, in simple terms, is something that can make money or grow in value over time. In investing, there are a few common types of assets. The first is equities, called stocks. When a company lists itself on a stock exchange, it splits its business into small pieces called shares. When you buy a share, you own a tiny part of the company. The second is fixed income or bonds. Bonds are basically loans. You lend money to a government or a company, and they pay you interest and return your money at the end of the bond period. The third is commodities, like gold, silver, oil, coffee, timber, anything physical. The fourth is real estate, often accessed through something called REITs. And the fifth is cash and cash-like instruments. An ETF can hold any of these assets. So there are equity ETFs, bond ETFs, gold ETFs, and many others. Each asset class plays a different role when building a portfolio, but for now I want to focus on equity ETFs. That's because historically equities have delivered the highest returns over long periods, especially if you're investing for 10 years or more. ETFs are themselves can be active or passive. Passive ETFs simply track an index that tend to be low cost, and active ETFs try to beat the market and usually cost more. Over long periods, most active funds fail to beat their index consistently, which is why you will often hear the saying, if you can't beat the index, be the index. But that raises another question. What exactly is an index? And where do global ETFs come from? That's what we'll explain in the next video.